Good morning. So we are going to be looking at credit risk management. And for Rsk4804, when you look at credit risk management, there is about 22 chapters that we need to make sure that we cover. And usually there's about 2 assignments. I'm still to get the tutorial later, but usually there's about 2 assignments that you also need to cover as well. And we are going to go through those 2 assignments together in class. And remember, your timetable is between now until end of October. Then we're going to post another timetable for you guys for revision, because between now until end of October, we should be done with the different study units. Then from November, December, January, until you write, whether it's in January or February, we're going to be looking at revision as well. So looking at the guideline of things that we need to cover, when you look at credit risk management, you are going to look at credit risk management from the perspective of the party who's basically giving credit. So we know when you look at from the perspective of the party who's giving credit, we know that the accounting equation says your assets is equal to equity plus liabilities. So your assets is equal to equity plus liabilities. So which means your equity is where we're looking at your ordinary share capital. We also look at reserves and whatever you have from your accumulated retained earnings as well. So from your retained earnings, you're also looking at is forming part of your equity. And when you look at liabilities, this is where we're looking at either your short-term liabilities or your long-term liabilities, which is basically when you talk about liabilities, we're looking at debt financing, right? So now we're saying to finance these assets, which are going to be generating income and returns for us, is either we're going to be getting financing from equity or going to be getting financing from liabilities. Now, when you look at credit risk management, we're now saying, as a financial entity that is looking to generate returns from these assets, you're going to be looking to generate returns from these assets by giving out credit. So you're going to be looking to generate returns from these assets by giving out credit. And this credit can be short-term credit or it can be long-term credit. So you're giving out credit so that from this credit that you're giving out to obligors, when we talk about obligors, we are talking about people that is going to be owing you money. Those are the people that you're financing basically. So when you finance these entities through giving out credit, you're now going to find out exactly how do you manage this credit that you're giving out, whether in the long term or short term. How do you manage to make sure that you are minimizing the risk from this credit that you're investing? Because remember, this credit that you're giving out, you are looking to generate returns. And now, how do you manage the risk that is going to be coming from these investments that you're making, which is basically from the credit that you're going to be giving out as well? So when you look at credit risk management, we're looking at the risk from the perspective of the party who's giving out credit. We don't look at it from the borrower's perspective. We look at it from the what? From the investor's perspective. To say, so how does the investor manage the credit of when they lend out money to the borrowers or the obligors? So that's basically what we're going to be looking at when you look at what? Credit risk management. Now, looking at this, so when you look at chapter 1, we look at credit basics. So when you look at chapter 1, you are trying to have an understanding of exactly what is credit. So you're trying to find out exactly, so what is the basic understanding of what credit is, and what are the advantages and disadvantages of an entity getting credit from different investors as well. Then from chapter 2, we're going to be looking at the essentials of credit risk analysis, to say, so when you do a credit risk analysis, what are the sources of information that you need so that you're able to come up with a decision on whether you're going to be giving out credit or not giving out credit as well. Then chapter 3, we look at credit risk management, where you're now saying, now that you've given out this particular credit to the obligor, Remember, whenever they talk about the obligor, they're talking about the customer or the borrower, right? Now that you've given out credit to this particular borrower, how does an entity manage the risk emanating from the borrower? Because remember, the risk that we're talking about there is the risk that the borrower might default, or is the risk that your returns might be lower than what you're anticipating if the credit is going to be based on whether it's a fixed from fixed interest rates that you're going to be earning or floating interest that you're going to be earning as well. Then we look at fundamentals of firm or obligor level risk as well. So which means now from chapter 4 onwards, so we know that overall you are not necessarily you're going to be giving out credit to individual customers or individual entities, but now since we're looking at it from the perspective of the company that is giving out, that is investing in giving out credit, it basically means that when you're now going to be giving out credit to 2 or more borrowers, you're now having what? A credit portfolio, right? Now, before we look at the credit portfolio, let's look at analysis of credit risk from the perspective of individual customers. To say, so how do you analyze the credit risk from the perspective of what? Individual customers. So that's when we look at the fundamental firm or obligor credit risk management. So when you look at firm or obligor credit risk management, that's when I'm going to say, when you're analyzing credit risk, we're now going to say credit risk is going to be made up of two, it's going to be emanating from 2 forms: business risk or financial risk. So it's going to be emanating from business risk or financial risk. Now, when you look at business risk, you're now going to be looking at what we call the EII, right? Sources of risk. So your business risk can be emanating from EII, where the first one is going to be your, so the first one would be your external risks. And this is what we are going to be covering in chapter 5. Then from there, we are going to be looking at industry risk. So from external risks, we're going to be looking at industry risk. And when you look at industry risk, we are now going to say, how do you analyze the risk? Remember, there are different industries that an entity can invest in. So because there are different risks that an entity can invest in, so we now need to find out exactly how do you analyze the risk emanating from the different industries, so that you know exactly which industries are having a higher risk exposures, or which industries are having what? A lower risk exposure. So which means when you look at industry risk, you are now looking at it from chapter 6. Then from there, we look at entity level risk, and entity level risk this is where you're looking at internal risk. So this is where you're analyzing the risk of the individual company. And this is what we're going to be covering in chapter 7. So when you look at external risk, you're looking at the risk overall. So which basically, this is where you're looking at analyzing risk from a macroeconomic perspective. Then from there, you now look at, so it's more like a diagram, which is something like this, where we are saying this is where you find the external risks, which is basically more broad. Then we look at the industry risks. Then you streamline it and you look at it from the internal risk. And the internal risk, this is where you are now looking at the risk from the individual company's perspective as well. So is the external risk is more broader. You're looking at the whole economy. The industry risk, you have now streamlined to say, so from the different, from the based on the how the economy is doing, which industries ideally are we more comfortable to give out credit to? So you need to analyze the different industries. Then within the industries as well, you now need to find out exactly how do we now analyze the potential companies that we can consider what giving out credit to as well. So this is basically where you're now going to be looking at what EII risks. Then we also look at the financial risk factors as well. So you see that in chapter 8, this is where we're going to be looking at the financial risks. And when you look at the financial risks, the main things that you're going to be looking at here, you're looking at analyzing the financial risk by looking at the ratios. And then you also look at the what we call the Z score. So these are the most important things that you need to make sure that you take out of from chapter 8. You need to be able to analyze and do the calculation, interpretation of the ratios. And you also need to do the calculation, interpretation of the what? Of the Z scores to say, how do you determine the probability of bankruptcy? To say, so does the company have a high risk of bankruptcy or a low risk of bankruptcy? So that's what we're going to be looking at when you look at financial risks. And this is what is going to be covered in chapter 8. Then from there, we now need to see exactly, so how do you now put all this analysis together? So you now need to say, okay, so how do we look at an integrated view of firm level risk? So which is what we're going to be covering in chapter 9. So if you look at the leading up of the different chapters, you see that, remember we said from chapter 4, we're going to be looking at fundamental firm or obligor level risks. And then from there, they're giving us an overview of how you analyze the firm or obligor level risks. And from there, we're going to chapter 5, we look at the external risks. Chapter 6, we look at the industry risks. And chapter 7, we look at the entity level risks, so which are all emanating from what? Business risk. Then chapter 8, we now look at financial risks as well to say, so how do you also look at the financial risk, which is the other component of risk that you need to look at when you look at what? Credit risk management for individual entities as well. Then chapter 9, we look at integrated view of firm level risk to say, so how do you now put all this together to be able to analyze the risk of the entity or company that you're looking at as well, and what are the different mitigants which are used or available to mitigate the effect of what these different sources of risk as well. Then, now that we've analyzed the individual companies as well, we also look to see exactly, so how do you determine now to say how much risk are you taking? Because remember, we know that when you look at the accounting equation, your assets is equal to equity plus liabilities. And what did we say? The goal of the firm is to maximize shareholders' wealth. So we know that the goal of the firm is to maximize shareholders' wealth. And in pursuing maximization of shareholders' wealth, it means we need to maximize the value of the firm, right? So which means the value of your assets is also the firm value. So the value of your assets of the business is also your firm value. So which means when you're now looking at credit risk management, you're now saying, how do we ensure that we're able to maximize the return from our short-term and long-term assets that you are investing in, so that we're able to get what? Returns as well. So the more the returns are able to maximize there, the higher the value of the firm as well. But what do we also know? We know the principle of investing is high risk, high expected return. Not actual return, but expected return. So which means an investor, the more return, when you're looking at a rational investor, the more risk they take, the higher the expected returns. So which means in pursuit of maximizing shareholder value, you also need to know that if you're going to be investing in high risk credit assets, the reason why you're doing that is mainly because you are also expecting what? A higher return as well from those credit assets. So which means, picture this. Before the 2008 financial crash that we had, the bigger banks were more conservative. So they were investing in credit assets which are not necessarily of high risk as well, right? So they were also investing or giving out credit to those companies that they were more comfortable, which they know that the risk was low. But what do we know? The lower the risk, the lower the expected return. Now, if you look at the trend of the banks as well, just after the 2008 financial crash, the smaller banks, they ended up saying that, you know what? Yes, we within the legal framework of exactly where which assets we're able to invest in, we can now be able to now mitigate the effect of this risk. Like, for example, if you're now going to be considered giving out credit to what? To the low income earners. So we know if you're going to be giving out credit to low income earners, your risk is high, but your expected returns are also higher as well. So that's why you see that if you look at post the financial crisis in 2008, the smaller banks, they jumped in, they started giving out credit to the lower income earners and found ways of mitigating that risk as well. And they were making a killing as well. That's why you see that eventually the bigger banks, they also jumped on board. And then they were, if you look at just after the 2008 financial crisis, the bigger banks also jumped on board. And then they also started going into the low income earning market and giving out credit as well. And then they would say, how do we mitigate the risk? Then they say, okay, fine, give us your pay slip, and you must be earning a minimum of, I think it was about 8,000 or so, where they say if you earning a minimum of 8,000 and you show us your pay slip and you give us this, then we can be able to give you credit. So which means they were now going more into this unsecured credit sphere, but at the same time, they were making higher returns because they needed what? To recover as well. So which means when you look at credit risk management, it's not necessarily that you always have to mitigate to expose yourself to lower risk so that you're able to have, but at the same time, if you're exposing yourself to lower risk, you are going to be earning what? Lower returns as well. But at the same time, if you are going to be finding ways of mitigating that risk and give out credit to the higher risk market as well, that's when you can now be able to mitigate that risk and get what? In higher returns as well. So you will see that when you look at chapter 9 and chapter 10, when you look at chapter 9 and chapter 10, the main thing that we're looking at here is that you're now going to see, so what are the different risk mitigants, and how do we now overall analyze this risk credit that we're considering giving out to customers as well, by looking at the business risk and the financial risk, and also how do we determine the probability of default within those customers as well. And you will see that the higher the probability of default, so which means that the higher the probability of default, the higher the credit risk that you're going to be exposing yourself to as well. When the probability of default is higher, the credit risk is also higher as well. So that's what we're going to be analyzing now to say, so how does these financial entities that are whose business structure is made up of giving out credit, how do they now make sure that they, in their pursuit of higher returns, how do they now be able to make sure that they're able to mitigate the risk that are going to be exposed to as well, by making sure that they calculate the probability of default as well. So this, you're also going to find it in chapter 20, and 21 and 22 and 21, 22, and 23, where you look at now how do you do the credit pricing as well to say, so based on the probability of default, how do we determine the credit pricing? We are not going to say if the probability of default is so much, how much should we determine as the credit pricing? Because when you look at credit pricing, which we are going to be looking at later on, but I'm going to discuss it now as well, we know that your nominal interest is given as your real rate of interest plus inflation premium plus risk premium. So your nominal rate of interest is given as your real rate of interest plus inflation premium plus risk premium. And then if you still remember from undergrad, we also said your nominal rate of interest plus the inflation premium gives you the risk-free rate of return. Now, depending on exactly how much the probability of default is and how much credit risk you are going to be taking, this is going to be filtered in when you look at the risk premium. So the higher your risk exposure, the higher the risk premium. So the higher the risk exposure, the higher the risk premium as well. So depending on exactly how much credit you're exposed, the risk you're exposing yourself to, depending on the credit grading that you're going to be giving the different customers as well, the higher the risk premium, the higher the nominal rate of interest. And remember, this interest is basically what we're referring as the credit price. Because if you're considered to be in a higher risk bracket, it means the interest rate that you're going to be charged is going to be higher as well. So if you're considered to be in a higher risk, you're going to be charged what? Higher rates of interest. So that's basically the blueprint of exactly how it works. Now the different entities now, they are now going to be having their own ways that in which they are going to be determining the credit price as well. Are there any questions so far before we go on? So, moving on. Chapter 11 is part 3 of the textbook. And in part 3 of the textbooks, we look at credit risks, in project and working capital to say, how do we determine the credit risk when you look at project management and also when you look at management of what? The working capital as well. Because when you look at project management, you're basically saying, if there is going to be a project that the obligor is going to be pursuing, how do we manage the credit risk? Because remember, we are going to be coming in as the financiers through debt financing, which is basically credit. So which means now, how do we analyze and understand the credit risk that is going to, if we're going to be coming in to finance a particular project that the obligor is going to be pursuing, how do we analyze and understand our credit risk exposure as well? So we are going to be looking at credit risk not in project finance. Then in chapter 12, we also look at credit risk in what? In working capital. Because we know your working capital is basically you're looking at your current assets, and your net working capital, you're looking at the difference between your current assets and your current liabilities. So when you look at short-term financing, when you look at your working capital, you're basically saying, how do you manage the credit risk from the working capital components of your obligors as well? And here, that's when we're going to be looking at the working capital cycle, where we look at the cash conversion cycle and analyze it in detail. Then we'll also look at the working capital risks as well, and we're going to look at them in detail to say, what are the different working capital risks and how do you mitigate them as well? Then chapter 13 falls under credit portfolio risks. Remember we said, after we have now analyzed the credit risk from an individual obligor's perspective or an individual borrower's perspective, how do we now, we are as an entity that is going to be doing business and giving out credit or lending out money, how do we now, instead of analyzing credit risk from one obligor's perspective, how do we analyze credit risk when you have 2 or more obligors? Because remember, when you have 2 or more obligors, it basically means that you are now having a situation where you have a portfolio a credit portfolio. So if you have a credit portfolio, how do we now analyze the overall risk of your portfolio? So that's basically what we're going to be looking at in what? In chapter 13. Then in chapter 14, we look at the major portfolio risks. Say, when you're now having a credit portfolio, what are the major risks that you're considering what? Looking at. And you will see that when you look at the major portfolio risks there, you're now going to, we know that risk, your total risk is made up of what? Two components. Your total risk is made up of two components. Your total risk is equals to your systematic risk plus unsystematic risk. Now, your systematic risk is, so we say your total risk is made up of your systematic risk and unsystematic risk. So how do you now analyze to say, how do you need to have an understanding of exactly what makes up your systematic risk. Remember, your systematic risk is also sometimes referred to as what? Your non-diversifiable risk, where no matter how many different obligations you have in your credit portfolio, that risk always remains constant because it's from a what? Macroeconomic perspective. So how do you manage this systematic risk of your portfolio? And also, how do you manage this unsystematic risk of your portfolio? The unsystematic risk of your portfolio, we also refer to it as what? Diversifiable risk. Because with the diversifiable risk, we're basically saying the more different obligations or different types of obligations you have, the lower the unsystematic risk. Because the unsystematic risk goes down with the different what? Obligations that you have. Because we know that if you have one obligor, if anything goes wrong, the whole portfolio goes down. But if you have a group of different obligors as well making up your portfolio, if one defaults, you're not necessarily expecting to lose out on what? On the other ones, because your portfolio is what? Diversified. So if your portfolio is diversified, you are looking to have a situation where we're saying, so ideally, when it comes to the credit portfolio, we are saying our ultimate aim of our credit portfolio is to have a situation where we're trying to do away with this diversifiable risk, so that we are only going to be left with what? Systematic risk. And in that chapter, we're going to be looking to see exactly why are we saying that we should only be left with systematic risk on our credit portfolio, and what is the reasoning behind us only trying to diversify our portfolio as much as possible so that we're left with what? Managing only systematic risk. So that's basically what we're going to be looking at in chapter 14. Any questions? Any questions so far? Any questions? Now, if you look at chapter 15, we look at firm risks to portfolio and capital adequacy. Now, let's go back to our accounting equation. Remember, we're saying when you look at the accounting equation, our ultimate aim, we want to try to maximize the returns that we're getting from our assets, right? Now, what do we see? Let's look at it from a perspective of the bank, right? From the perspective of the bank, the debt financing that they can get here, a typical example of the debt finance that they get is money that they get from depositors, right? And we know that for a financial institution like a bank, we need to make sure that as much as possible, we protect these depositors from what? Losing their money. We want to make sure that we maintain confidence in our financial markets by ensuring that the banks protect the depositors as much as possible. A typical example of this, look at the case of VBS Bank. You had a situation where when things went wrong, depositors lost confidence in VBS, And what was happening with depositors? They were standing in queues trying to get back their money. But now you see that in chapter 1, when you look at the flow of funds within an economic system, you will find that from 100 Rand, this 100 Rand in the financial system can be given out as credit to so many people. So you will see that the amount of funding or equity that the bank has is very much small compared to their risk exposure of what they're giving out as what investments in what that they're giving out as credit as well. So now we need to make sure that we protect the depositors as much as possible. So which means now when you look at chapter 15, we're now saying, how do we ensure that we are able to have enough equity available so that if there's going to be any losses here, they're going to be mitigated by what? By equity. Like, for example, we say if we have our assets which are worth 1,000 Rand, and you have equity which is worth, let's say, from these assets which are worth 1,000 Rand, we have equity, they are financed by equity which is worth, let's say, 80 Rand. And then the other 920 is coming from debt financing. Now, our aim is to ensure that if there's going to be any losses from the credit assets, because remember, when you look at the credit assets, when we give out credit, not all our customers are going to be able to service their obligations. Some of them, because of different economic conditions, they might end up defaulting and all those things happening as well. So our ultimate aim is to ensure that if there's going to be any losses incurred here, we have enough equity available, or we have adequate capital to mitigate the losses that emanate from here, so that we're able to protect the debt financing, especially the depositors. So which means, like, for example, if we are going to be suffering a loss of, let's say, 20 Rand, remember, on our accounting equation, it means here we're going to be left with 980 worth of assets. Now, this 980 worth of assets, it basically means that the loss of 20 Rand is going to be subtracted here, which means we're going to be left with what? 60 worth of what? Of equity, and we still have 920 worth of depositors. So which means your accounting equation is going to be 980 is going to be 980. So which means we are not dipping into the depositors' money, for example, to mitigate the effect of these losses. A typical example is where we are saying, for example, if we now suffer losses worth 100 Rand, if we suffer losses worth 100 Rand, what is going to affect this loss on our accounting equation? It means we're going to be having our assets worth 900 Rand, and here, to this loss is going to be covered by loss in equity worth 80 Rand, which means equity is going to be worth 0, but it is not yet covered this money of 100 Rand. So which means we're going to be forced now to, the depositors are also going to lose out on the extra 20 Rand, so that the depositors are only going to be able to recover 900 Rand. So it means from whatever amount that they've invested, they're not going to be able to recover the full amount. They're only going to be, from the 920 that they've invested, that they've put in the bank, they're only going to be able to recover in total 900 Rand. So that's basically how it looks. So when you look at chapter 15, when you look at risk, firm risks and portfolio risk and capital adequacy, well, basically the main idea is we're trying to say, how do we ensure that we have enough capital available to mitigate any losses that emanate from our credit assets? That's basically the main thing coming from chapter 15. So which means when you look at chapter 15, that's when you're now going to be looking at concepts where you are trying to find out exactly, so how do we determine how much capital do we need to maintain? So based on that, that's when you see that we look at concepts like, for example, calculation of the expected loss, so that we're able to now estimate to see exactly how much capital do we need as well when it comes to the credit risk. Then chapter 16 looks at credit risk and the Basel Accord. Now, we see that, remember we say we want to, with every economy, you want to make sure that there is confidence in the economic system. If there's no confidence in the economic system, it means that the customers are not going to be able to transact and the economic system is not going to be able to run very well. So when you look at credit risk in the Basel Accords, we are now basically saying that how has the mitigation of credit risk evolved when we look at the transformation of the or implementation of the different Basel Accords? Because remember, these Basel Accords have been improved over and over and over again as well. And you see that soon we're going to be looking at the Basel IV as well. So what does that mean? It basically means when you look at the transformation of the Basel Accords, we see that initially when you're now trying to find out exactly how much capital you need to maintain capital adequacy, initially we will only take into account credit risk. But over time, they've also realized that, you know what, the losses that we suffer from our assets are not necessarily only emanating from credit risk. We also have other sources of risk, like, for example, market risk that we have to take into account. So if you are going to be taking into account other sources of risk as well, how do we ensure that we have enough capital available to mitigate the effects of these losses that we are going to be suffering from our credit assets as well? So that's when we're going to be looking at the Basel 1, 2, and 3 as well. Then from there, chapter 17, we also look at credit risk. When you look at portfolio risk mitigants, to say, so what are the risk mitigants available when you look at the mitigating the risk of your portfolio of credit assets? So we look at chapter 17, we look at credit risk diversification, to say, so how do you diversify your portfolio of credit assets? And there are different ways that you can diversify the risk of your portfolio of credit assets. Chapter 18, we don't cover it, so we leave it out. Then we'll also look at chapter 19, which looks at credit derivatives. Now, when you look at credit derivatives, we saw that, for example, if you look at the financial crisis in 2008, the reason why if you look at the history or the source of the financial crisis in 2008 is where we're saying, for example, we had a situation where in America, they were pursuing the American dream and they were giving out to mortgages to customers who under normal circumstances would not have qualified to get financing for this mortgage loans as well. So now you have a situation where you have these loans where financial institutions, they now package these loans into different credit assets, and then they sell these credit assets to other investors across the world as well, in simple terms. So which means you have a situation where other investors, they sell to these other investors as derivatives, because remember, the value of these credit assets is basically derived from the underlying security, which is basically the mortgages that were being given out as well. So you have a situation where an investor doesn't understand what makes up the underlying security and what are the risk factors that makes up the underlying security as well. So which means you are now having a situation where investors are investing in something that they don't fully understand. Then over time, when the defaults came, even those credit assets which were given a grading of AAA ended up defaulting, which is usually an unusual scenario as well. So because of this, which means from chapter 18, we now need to find out exactly, so what are the credit assets available, and how do you now understand the securitization of exactly what is the different ways that you can look at securitization of these credit assets on how, so that when you invest in them, you have an understanding of exactly what you're investing in them and what is really the underlying securities under those credit assets as well. So we're going to be, that's what we're going to be looking at in chapter 19. Then chapter 20 is this the last part of the textbook, which looks at credit risk pricing. Remember, I've already highlighted this to say your nominal rate of interest is given as real rate of interest plus inflation premium plus risk premium. So now, how do you ensure as an entity investing in credit assets that you are properly accounting for this risk premium, so that depending on the risk premium that you're taking, you're also putting out the proper pricing of the credit assets as well. So the price of the credit asset is the overall interest that is going to be charged to us, to the borrower as well. So how do we ensure that we are able to properly price these credit assets? So you see that in chapter 20, we look at the pricing basics. Then in chapter 21, we look at the pricing methods to say, so what are the different methods available that we can use to price these credit assets? Then on the next part of the textbook, we now look at the last line of defense, which is basically the security, where we are saying that in case of default, how do we mitigate the losses that we can potentially incur? And one way that you can mitigate the losses that you can potentially incur is through having security. So you're now going to say, for example, if you want us to give you, let's say, for example, you have a fully paid house of $1 million, then you can approach the bank to say, can you please give me a loan for 500,000, and I'm putting my house as security so that in case I default on my obligation, you can now be able to attach my house and sell it and recover your money. So chapter 22, we look at security. What are the different, what are the advantages and disadvantages of having security for both the borrower and the lender as well? Then chapter 23, which is the last chapter, we also look at covenants, where we are saying, when you look at collateral and covenants, we're now looking to see exactly, so what are the different collateral security that you can be able to have to make sure that you mitigate the risk? So which means that the security that you're giving out, is it tangible security or is it what? Intangible security. So which means when you look at, they give us the different forms of tangible securities, securities available, and they also give us the different forms of what? Intangible securities available as well. And then they also look at methods of taking security, and also the different covenants available, and also when that do we now say that if the certain covenant is put in place, what are the triggers for you for us to say you've transgressed what? The different covenants as well. So that's basically what we're going to be looking at in what? In chapter 23. So that's the overall view of what we can expect to encounter when you look at credit risk management. And remember, the most important thing is that you are looking at credit risk management from the perspective of the lender. So you are looking at credit risk management from the perspective of the lender to say, so as the lender, how do you manage the risk emanating from your credit assets, where you're giving out credit as a form of investment what? To your borrowers as well. Are there any questions? Any questions? So looking at chapter 1, chapter 1 looks at credit basics. And in chapter 1, under credit basics, on section 1.1, we look at the meaning of credit. And if you check on line number 3 of section 1.1, they say, roughly, we can define credit as a transaction between two parties in which one, the creditor or lender, supplies money, goods, services, or securities in return for a promise of future payment by the other, which is the debtor or borrower. So such transactions normally include the payment of interest to the lender. So the compensation for foregoing consumption of this resource is what? So the compensation that has to be paid by the borrower to the lender for deferring the consumption of this resource is basically what we refer to as what? As interest. So which means, in essence, we are saying credit is not free. So which means there is going to be a price to the borrower for getting that credit as well. Then on page number 5, they say, naturally, a small percentage of debtors won't pay back the credit as promised, sometimes even sending the creditor into bankruptcy. But the majority of debtors meet their commitments. So that is why the world economy survives. So credit losses or bad debts occur in both finance and non-finance businesses. So the reasons vary. In certain cases, if the credit is extended to crooks, it is a bad debt from inception. However, the bulk of credit losses happen because of genuine business failures. The reasons vary from increasing competition, new technology, substitute products that are offered by competitors, increase in prices, decline in demand, overestimation of demand, oversupply position in the market, government regulation, union problems, mismanagement, death of key persons, business cycles, overambitious projects, financial losses, excessive leverage, concentrated exposure, defective diversification, and so on. So a proper credit analysis, risk analysis, will bring to light the probability of credit loss arising out of genuine business factors. So there are situations where the creditor ends up losing even if the debtor settles the dues on time. So 3 such situations are described below. The first one is an instance where the one instance of what? Of inflation. So if the rate of inflation exceeds the interest rate, the supplier of credit are badly affected. So which means when you look at the instance of inflation, we're saying, if you have 1,000 rand today and you lend 1,000 rand to a customer and you charge them interest of, let's say, 10% interest per year, or let's say it's 5% interest per year, right? It means your money that you're going to be expecting to get after 1 year is 1,000 rand plus the 5%, which is 50 rand. So you're going to be having assets worth what? 1,000. You're going to be having 1,050. Now, what do we see? So we see that if you are having 1,050, now you have to ask yourself, if I'm going to be having 1,050 today compared to having 1,050 after 1 year, if I'm going to be having 1,000 rand today compared to having 1,050 after 1 year, so what is the effect of inflation on my returns? So which means if your inflation rate is 10%, it means the amount of goods that you're going to be able to buy with 1,000 rand today is a lot less than what you could buy with the same 1,000 rand what after 1 year, because of the effect of what? Of inflation. Because now, if you defer consumption of your money today, it means instead of buying that asset for 1,000 rand today, after 1 year, are you going to be able to buy that same asset as well? Considering that after 1 year, you're going to be having only 1,050, but that asset now is now going to be priced at what? because of inflation. If it's 10% inflation, it means that asset today that's costing 1,000 rand, after 1 year, it's now going to be costing you 1,100. But because you've invested this money, you're only going to be having what? 1,050. So do you see that because of effect of inflation, you're worse off than where you are after 1 year than where you are now because of what? Effect of inflation. So the effect of inflation is one instance that causes what? A loss to the lenders. The second one is that to say, in the second instance of devaluation of foreign currency, in which the debt is denominated, the creditor loses on the extent of the rate of devaluation. So this, when you look at devaluation, this is where you're looking at what? Movements in exchange rates, where we are saying your investment or the money that you're going to be lending out to a borrower, for example, in another country, is going to, when they eventually pay you back, if the currency devalues, you're going to be able to buy less things compared to what you could have been able to buy what with that same money in that particular country as well, because of the effects of what? Of devaluation of your currency as well. The third one is another instance will be non-compliance with anti-money laundering measures implemented by the central banks of most countries. So that's why you see when it comes to banks, they look at the KYC, which is the know your customer policies and procedures as well. So that's why you see that, for example, if you look at the case where MTN was in, I think it was a couple of years ago, where MTN was in a lot of trouble with where you are looking at a situation where you are giving out credit to a particular customer, but at the same time, if you don't do the proper know your client procedures there, you're going to be now finding yourself where you're going to be caught up with what? Money laundering issues as well, where you have not done the proper due diligence before you give out the customer credit as well. Like, for example, that's why you see that most banks, they ask you to say, if you're going to be applying for a loan, they want you to make sure that you bring out your ID and you bring out what? Your proof of residence as well, so that you're able to, they are trying, in a way, they're trying to avoid the issues of what? Money laundering, so that you know exactly what client are you dealing with and what is the background of this particular client as well. And this is where you look at banks like, for example, HSBC was finding itself in a lot of trouble. If you look at HSBC, where they were now being accused of facilitating banking transactions for people who were dealing with drugs or other illegal things as well, because they're not following what? The proper procedures of what? Know your customer as well, policies as well. Then they say, similarly, if sanctions are imposed on certain countries, then dealing with or lending to the customers in such countries can also spell troubles and result in what? In losses. So it will be very, very interesting to see exactly, considering that the Western countries are pushing for sanctions on Russia because of the invasion of Ukraine. So it will be very interesting. So it will be very important for banks as well to keep tabs of exactly what are the sanctions that have been imposed, so that they don't end up transgressing those sanctions as well. Because if they end up transgressing those sanctions, they might end up being what? Being fined as well. Then here they say, while it's the risk that the borrower may default on obligations is known as credit risk, the risk that foreign government may fail to honor the credit-related obligations is defined as sovereign risk. So it may be noted that legal remedies in the event of sovereign risk are limited. Hence, when extending credit to a business firm located in a foreign country, it is better to ascertain the level of sovereign risk than to study the credit risk of the business firm as well. Because remember, you're now going to be looking at the attitude of what? The different governments that where the obligor basically is emanating from. Are there any questions from section 1.1 before we look at section 1.2? Any questions? On section
Renus.
Yes.
Hi Renus, just to take interest on the sanctions part. How exactly does it work? So who will impose the sanction on a particular party, and will then come back and say, you failed to comply with these sanctions, and therefore we're gonna penalize you. Just the process around sanctions, how does it work?
It do not depend on, for me, it depends on the level of influence that the different countries have on the different financial bodies within the financial system in the world as well. Because remember, within the different financial bodies, this is where you now look at a situation where the different financial bodies, different countries, they are members of the different financial bodies. Like, for example, if you look at the World Bank and the IMF as well. So which basically means that we know that different banks, they are also on their own, they are also going to be needing financial assistance from all these other different financial entities as well, because they're not able to operate on their own. That's why you see that if you look at the case of Russia, how they're basically imposing the sanctions is where they're now going to say, we are going to be removing you from the SWIFT system, which means that it makes it difficult for the other financial institutions and people in Russia to be able to transact across the world. So for me, the sanctions is very subjective in the sense that it's now the imposition of the sanctions and also the monitoring of the effects of these sanctions is now very much dependent on what the different members of the bigger bodies that are basically making up what that have more influence on the financial systems across the world as well.
Okay, all right.
Yeah. So you will see that, for example, if you look at, let's say, for example, there is sanctions that have been imposed on Russia, but then at the same time, a South African bank decides not, we're going to be giving out credit to whatever entity that they are saying that we should not be giving out credit to, who's in Russia as well. So what is going to happen? It basically means that you are worried about, as a bank in South Africa, you're worried about that because they're going to say, so if you're going to be saying that you're going to be supporting these particular entities as well, and we've imposed sanction on them, so it basically means that we're also going to be withdrawing our assistance to you as a financial institution in South Africa. And we know that when you look at the financial system across the world as well, it's difficult for you as an individual bank or as an individual economy to operate on your own. You always need to be linked with other financial institutions across the world as well. And if they're not going to be willing to do business with you, it basically means that you're going to be finding it very difficult to do business across the world, which means that you end up suffering losses. And sometimes they might even impose fines or penalties on you as well, because you're basically a member to a particular body that basically monitors or runs the different financial systems across the world as well. Are we on the same page? All right.
Yeah.
Are there any other questions? Are there any other questions? So this is why you see that when it comes to the issue of sanctions, for sanctions to be effective, it means, that's why you see that even America on its own, for them, when they're saying that, okay, fine, let's sanction Russia, they're not going to be saying we're going to be sanctioning Russia on our own. They're now seeking, that's why you see that America is busy seeking support from the different countries across the world, so that the idea behind sanctions is basically to isolate a particular deemed transgressor of something as well. Because for the sanctions to be effective, it means other people need to be in agreement. That's why you see that they are now pushing for other countries across Europe and also across the world to be agreeing to the sanctions that are being imposed. Because if more people agree to the sanctions that are being imposed, the more effective the sanctioning becomes as well. Are there any other questions before we move on? On section 1.2, we look at the role of credit. And when you look at the role of credit, we're basically saying idle economic resources can be effectively put into use through credit. Like, for example, we look at the link between the investor, the financial institution, and the borrower, right? So we know that the investor is the one who has idle economic resources, because you're saying, I have 1,000 rand. I have no use for this 1,000 rands today. So instead of me just putting this money under the mattress, let me put it into the bank, which is the financial institution, so that the bank is able to make the best effective use of this 1,000 rand, while least I don't need to use it as well. So which means, so credit helps the flow of funds in the economic system. So which means that those idle economic resources are going to be better utilized by those parties who need those economic resources as well. So here they say the main function of the financial system in any country is to mobilize resources for economic growth. So the financial intermediaries not only intermediate between savers and investors, but set economic prices of capital in line with the monetary policy of the nation as well. So that's why you see that when you're looking at the pricing there, this way they are going to be saying, for example, they are going to be charging you prime plus or minus a certain percentage depending on your credit rating as well. Then on section 1.3, we look at the credit market. And when you look at the credit market, we say the demand for credit is ubiquitous as the economic agents feel scarcity while pursuing unlimited ones with limited resources. So when you look at ubiquitous, you're basically saying that it's found everywhere. So which means that the demand of credit is basically found everywhere within the economic system. So here on page 7, we're saying the granting of credit to commercial customers is more complex than personal credit. This is because commercial borrowers are engaged in a much wider range of activities, and their needs of credit vary according to the nature and size of their operation. So when you look at commercial customers, this is where you're looking at giving out credit to companies compared to giving out credit to businesses. So for personal use, you know that if you give us credit to a particular customer, it's either they want to go buy a dress, they want to go buy a car, they want to go buy a house as well. But when you now look at commercial credit, it basically depends on exactly, there's a wide range of things that commercial customers are going to be needing, depending on exactly which industry and what are their operations that are basically seeking to achieve with this credit as well. So they say business credit is the most common, but for which world trade and economic progress of mankind would have been without which but for which trade and economic progress of mankind would have been impossible. So which means that without business credit is going to basically means that without business credit, it basically means that economic growth would have been very difficult to achieve, and our progression for example, when it comes to technology-wise, it's going to be very difficult to achieve, because if you're going to be, for you to be able to research more, for example, in technology, you need credit so that you're able to finance different research programs that you need for you to be able to come out with better products as well in the world, which basically improves our daily well-being as people as well. On section 1.4, we look at credit advantages and disadvantages. So we now need to say exactly, so what are the advantages of having credit within an economic system, and what are the disadvantages of having credit within an economic system? So here they say, like fire, if used cautiously, credit is useful to mankind. So when you look at the merits of credit, when they talk about the merits of credit, you are looking at the advantages of of having credit within an economic system. And the first advantage that they discuss here is wealth creation and maximization. And yet they say, while the purpose of this book is to deal with the credit risk of commercial credit, it seems appropriate to mention that even governments borrow money much along the lines of business credit. So such loans are expected to be repaid from future government revenue, like for example, through revenue of taxation, customs, and other revenue, or foreign aid. So when you look at revenue from government, this is basically where we look at, for example, if you look at the effects of e-tolls, the reason why the government was pushing for e-tolls is mainly because, remember, they borrowed money to upgrade the road networks, and because they borrowed money to upgrade the road networks, for them to be able to service that debt that they've borrowed as well. That's why they were pushing for what? For e-tolls, because they need now to be able to what? From the income that they're going to be generating, they need to be able to pay the interest on the borrowings, and they need to be able to pay what? Pay back the principal on the what? On the borrowings as well. So that was the plan. Then, so here they say, if used wisely, credit helps in multiplying the wealth much faster and beyond the resources of a nation or business enterprise or individual. So here they say, we are basically saying, when you look at the use of credit, if you need to buy an asset that is going to be able to generate your business money in the future, it means if the asset is going to be costing worth 1,000 rand and you only have 500 rand, it means you have to wait a longer period of time to accumulate the full 1,000 rand when you only have what? 500 rand. But now, because of the issue of credit, it means you can now go and borrow money from the financial institution like a bank, the other 500 rand, so that instead of you waiting 1 year to start the project, you can actually what? Start the project now through debt financing. Then the other reason is as a tax planning tool. And here they say, in several nations across the world, income tax legislation allows the deduction of interest and installments on housing loans obtained by the salaried classes and self-employed as well. So as a tax planning tool, we're basically saying debt financing allows you to pay less in taxes. So as a typical example, we would say, let's say we are having a company with no debt, right? We have a company with no debt. It means, let's say the earnings before interest and tax is 100,000. It means the interest expense is going to be equal to 0, and the earnings before tax is going to be 100,000. And if they're going to be taxed at 28%, it means this company is going to be liable to pay 28,000 in taxes. Now, let's look at another example where the company has a debt financing worth, let's say, for example, they have debt worth 50,000. So as part of the financing, they're using debt worth 50,000. So it basically means if this company, maybe let's say they have a debt worth 50,000, charged at 10% interest. So it means for this particular company, the earnings before interest and tax will be 100,000. The interest expense is going to be 10% of 50,000 would be 5,000. So it means the earnings before interest and tax, so the earnings before tax is going to be 95,000. So their taxes at 28%. So what is 28% of 95,000? How much do you get? So what is 28% of 95,000? How much do you get? What is 28% of 95,000?
26.6.
26,600. So do you see when they're talking about debt as a tax planning tool, do you see that instead of you paying 28,000 as taxes to the government, because you're utilizing debt, you're only paying what? 26,600. So debt basically gives you a tax advantage. Are we on the same page? All right, any questions? Moving on, the next reason or the next advantage, they look at convenience and they say they tend to debt, which is convenient method of raising funds, which can be returned later. So which means, like what I say, with equity financing, you have to accumulate your money in your reserves for you to be able to finance the project. But with debt financing, it's convenient in the sense that you're able to get money now instead of waiting to get that money later for you to be able to what? To start the project as well. So which means that in this case, a convenient way of raising money is through debt financing, because you're able to get the money now instead of waiting to get that money later, which means you're getting money now so that you're able to what? To repay it later, instead of what? Having to wait to raise the money yourself internally, and then later on you can only start the project as well. Then the next advantage is business control. And they say, when you look at debt financing, remember we say your assets is equal to equity plus liabilities. And your equity is your ordinary share capital. And your liabilities is basically your debt financing. So what do we know? If you issue equity, it means, for example, if you're not able to raise the money that you need to buy the assets now, remember we say your assets is equal to equity plus liabilities. And your equity would be your ordinary share capital, and your liabilities, this is basically the debt financing. So what do we see? If you issue equity, if you want to raise money to buy the assets, and internally you're not able to raise that money yourself, if you're going to be issuing equity, it means you are having external people now becoming form of what? Part of the owners of the business as well. So it means you're now having external people becoming part of the company as well, which means that if the external people becomes part of the company, if you're owning 100% of the company and you issue equity or ordinary shares to other people, it means instead of owning 100% of the company, you're going to be owning less percentage of what? Of the company, which means that your controlling interest in the company is becoming lesser and lesser if you're issuing more external equity financing. But with debt financing, because they don't have, generally, your lenders don't have a voting right, it basically means that if you issue debt financing, you're still maintaining what? Control of the entity, because remember, with debt financing, they don't have a voting right because they're not necessarily what? The owners of the business as well. So if you want to be able to maintain control of the business, you can be able to achieve that through debt financing. So here they say, with borrowings, the existing owners can enjoy the full benefits of the business after meeting the fixed finance obligation. Because we know with debt holders, whatever interest expense that they're going to be receiving there, they remain the same. So which means during those periods where you're able to have a high profitability, it basically means that your earning per share is also going to be higher as well for the ordinary shareholders. So which means but the moment you start inviting external parties to become part of the owners of the business as well, it basically means that during those periods where you're having high profitability, your earnings per share is going to be diluted as well. Then the fifth one is the socio-economic advantage. And here they say, the increased spending results in more income, rising profits, and higher net worth of business, which in turn results in higher capacity to borrow, which encourages banks and lending institutions to lend more increasing the spending and investments further in the economy. So all this will result in higher employment creation and improved standards of living. So here they say, when you look at the social economic advantages, we're basically saying, if companies are able to borrow money, they are able to what? To produce more goods, which also means that if individuals are also able to borrow money, they are able to what? Use that money to increase the spending, which means that the goods that are going to be produced by the companies there are going to be what? There's going to be more demand of their goods. And if there's more demand of their goods, what is going to happen? There's more increased spending, which means that the companies are going to be able to what? To make more money. And if the companies are able to make more money, they're able to what? In simple terms, they're able to employ more people. And if they're able to employ more people are being employed, it means the unemployment level goes down, which means the standard of living is expected to increase as well. So that's basically the effect of the socio-economic advantage of what? Of credit within a particular economy. Then they also say, however, credit-induced growth needs to be monitored closely by the government and monetary authorities as it carries bubble risk. So which means you want to have a situation where you are, because of use of credit, you are borrowing more and more money, and you are having a bubble, which is not necessarily what? Being met by the increase in demand. So which means if the company now end up having to produce more goods because they're able to borrow more money, but at the same time, there's no supporting demand of their goods and services as well, what is going to happen? It basically means that the bubble is going to eventually burst, because eventually they're going to have a situation where they're now having excess goods which are not being what? Being bought as well, which means that eventually the whole system crashes down as well. Are there any questions regarding the advantages of credit? Any questions? On the next section, we look at the demerits of credit usage, which is basically the disadvantages of what? Of credit. And here they say that major demerits are reduced profitability, where they say, as far as the business credit is concerned, it is true that the return on investment exceeds the borrowings. Leverage is beneficial to borrowers. On the flip side, when the return on investment is lower than the borrowing cost, the business will suffer from lower profitability. So which means here we're basically saying, if your rate of return, remember we're saying the goal of the firm is to maximize shareholders' wealth. And how do you maximize shareholders' wealth? By ensuring that your return on investment is more than the cost of capital. Because remember, when you borrow money, you need to be able to, you are going to be charged a certain interest. So you need to make sure that whatever return that you're generating from the borrowed funds, it must be more than the cost of capital. Like, for example, if you're going to be charged a 10% interest, it means your return from your operating activities there should be higher than what? 10%. If it's lower than 10%, what does that mean? You are having a situation where you are suffering losses because your profitability is not enough to meet what? The cost of financing as well. The next one is default and bad reputation. So the main idea is that when you now end up failing to meet your interest obligation or your principal repayments, if you default on them, what is going to happen? It basically means that you are going to have a situation where your cost of borrowing is going to end up being high going into the future. And you're also going to be suffering what? From bad reputation, because people are going to be thinking twice before they do business with you, because they are thinking, your customers are going to think, if the company is defaulting, is it going to be able to continue running going into the future? Which means that they're worried about the security of the products that they're going to be considering getting from you. And your suppliers are also going to be worried to say, if this company has borrowed, is defaulted on their obligations as well, what is the probability that even if you supply them with goods on credit, they're not going to be able to default on their obligations as well? So which means the company ends up having what? A bad reputation within the economic system as well. Then the third one is bankruptcies. And here they say, almost all bankruptcies are caused by creditors pressuring the borrower to pay up So bankruptcies are not good for the creditors either, as they cause credit losses impacting their profitability. So which means when it comes to the issue of bankruptcies, we're basically saying if you're not able to now meet your obligation, you are going to be having a situation where your lenders are going to pressure you to now wind up your operations or to sell your assets to meet their obligations. But you're now going to, in most cases or majority of the cases, you see that if the company is declared bankrupt, you will see that what the lenders end up getting is a lot less than what they initially given you as funding as well. So which means bankruptcy negatively affects both the lender and the borrowers as well. So the more debt financing you're getting, the higher the probability that you might end up defaulting on your obligation. And if you end up defaulting on obligation, it basically means that the more debt financing an entity has, the higher the probability of it ending up defaulting on their obligation, being declared bankrupt as well. The fourth one is propensity to overspend. And here they say the main disadvantage of users of credit is the tendency to overspend beyond their means. So unexpected drying up of future inflows, say loss of a job, fall in income from business, sudden delay in collection receivables, accumulation of unsold inventories can result in repayment defaults and associated costs such as penals on interest, and finally confiscation of the collateral, if any, plus the associated damage to personal prestige as well. So basically, these are the disadvantages of having of credit as well within an economic system. So are there any questions regarding the disadvantages? On the next section, they say, so is wealth creation through use of credit easy and simple? And on page 11, they say, another interesting case is the US before the credit crisis. So we'll discuss this roughly later. So which means when you look at the credit crisis, that's basically what I was discussing previously, where you look at mortgages where customers were getting credit which they didn't qualify for. So you have a situation where the economic growth because the system is working, but the moment the default starts coming in, this is where you're now saying that you're realizing that even though wealth was growing because of use of credit, because now you're giving out credit to customers who didn't qualify for that particular credit, you have a situation where the economic system ends up crashing down as well. On section 1.5, we look at the suppliers of credit. So the suppliers of credit, typical examples of suppliers of credit would be the commercial banks, the term lending or development institution, like for example, the PIC, when you look at it from the case of from the South African perspective. Then you also look at the public debt management. Then you also look at other institutions in credit financing. And yet they say a host of other entities undertake credit financing as part of their normal operations. So the housing finance companies, hedge funds, non-banking subsidiaries of major multinational companies are some of the significant players in this segment. So insurance companies have a large pool of resources at their disposal, which are also deployed in a variety of lending or investment activities. So like, for example, if you look at insurance companies, you see that when customers pay their premiums, now the insurance companies now take that money and invest it as well. Like, for example, if you look at Liberty, they take that money that you're paying as premiums, they buy or invest in real estate. Like, for example, they investment in what? In Sanctions City as well. Then you also look at trade credit, where they say another source of credit is the supplier or trader or manufacturer who offers credit for short periods ranging between 30 to 120 days. So which means if you're going to be getting goods on credit from your supplier, it's basically another source of what? Of credit as well. Are there any questions regarding the different sources of credit? On section 1.6, we look at credit risk study. And here, I don't really think that I didn't highlight it because I don't see anything that I would say is something that would be I didn't highlight because I didn't see something that I would say would be examinable in the exam as well. So you can just go over it because they're just showing you the changes and the evolution of the credit study. But over time, I don't really think that there's something that I would say is highly examinable here. Now, on the next section, which is the last section, we look at the appendix where you look at credit creation. Now, when you look at credit creation, they are giving us that case study to say, for example, how credit is used to create even a bigger credit advancements within the economic system as well. Like, for example, you have a bank, and this particular bank is required to maintain 10% in reserves. So which means whatever money is deposited by customers within its banking system, the bank has to maintain 10% of that money. So it basically means in the first transaction, the bank gets 10,000 deposit from the customer. So if they get 10,000 deposit from the customer, they are going to maintain 1,000 as 10% in their reserves. So which means they can now give out credit of 9,000 to customers, to other customers as well. Now, these other customers, they're going to spend that money somewhere else. And that same 9,000, in simple terms, whoever they spend that money on, they make money, and that same 9,000, it comes back to the bank again, because that person that the customers have spent that money on, that have been received as financing as credit financing from the bank, that person that they've used or spent that money on now comes back and deposit 9,000 into the bank as well. So if they deposit that 9,000, the bank is obligated to maintain 900 within the banking system. It means they are going to be able to advance how much? 8,100 to other customers as well. And these other customers, they're going to spend that money somewhere else. And whoever they spend that money on, they're going to come back to the bank as well and deposit that money as well. And then they're supposed to maintain 10%, so they are able to give out this credit, all the same 10,000. So do you see that it's a cycle that goes on and on and on, which means overall, they are going to be having a situation where the bank is now having deposits worth 100,000. So from the 10,000 deposit initially there, they are going to be having 100,000 worth of deposits that they've received from the customers of the same amount of 10,000. They now have created 100,000 worth of deposit. They are sitting with a 10,000 rand reserve, and they've managed to able to give out advances of 90,000. So do you see that from the 10,000 deposit that the bank has received, they are now in a situation where they're able to give out 90,000 worth of deposits as well. So here they say the amount of credit the bank system can create with a single initial deposit can be calculated by the following formula, where we say credit creation is equals to the initial deposit multiplied by 1 minus the reserve ratio divided by the reserve ratio. So which means in this case, when you look at credit creation, it basically means that your credit creation, remember we said your credit creation is given as your initial deposit multiplied by 1 minus the reserve requirement divided by the reserve requirement. In our initial example, we saw that the initial deposit was an amount of 10,000. We have a reserve requirement of 10%, so the reserve ratio is 0.1 divided by the reserve ratio of 0.1. So in this case, how much is the credit creation that we have? So how much credit have we been able to create from the initial deposit of 10,000? So if you do the calculation, how much do you get there? How much do you get if you do the calculation?
It's 90,000, Reynolds.
So it's 90,000. So do you see that from the initial 10,000 deposit that the first customer deposited there, we have been able to create credit worth 90,000. That is expected to give us what? Financing as well. So because of this ripple effect, that's why you hear in the market that what? Banks are highly leveraged. That's why you hear that banks are highly leveraged, because in actual fact, the bank has only received 10,000 rand, but it has been able to create a credit asset which is worth 90,000 from that what? Initial 10,000 deposit. And that's why you see that when you look at the economic system, or they basically say we need to make sure that we maintain confidence in the economic system. Because if we don't maintain confidence in the economic system, you are going to have a situation where if customers run to the bank, the customers are going to be demanding 100,000, but the bank in their books they're only going to be having what? 10,000. So for them to be able to maintain the economic system, that's why we say the customers we have to maintain what? A confidence within the financial system in the economy as well. And that's why you see that the central banks are very much concerned when you hear stories about things happening in the different banks, like for example, the VPS bank. Because if customers run for the money, most likely those individual banks are going to struggle to what? To meet the withdrawals or the needs for the withdrawals as well. So are there any questions from chapter 1? Any questions?
Reynolds, just out of interest, the reserve ratio, is that something that is always given, or is there some kind of calculations to it as well?
It's always given.
It's always given.
It's always going to be given. You understand it in detail when you look at the capital adequacy ratio as well, but you are always going to be given the reserve ratio. There's no way they will ask you to calculate the credit creation if you don't have the reserve ratio, unless maybe, which I don't really expect them to do, but if maybe sometimes they can ask you to say the credit creation is this much, the initial deposit is this much, then how much is the reserve ratio? So it's more like mathematical manipulations, if that is the case. But in most cases, if they ask you for the credit creation, it means they'll have to tell you exactly what the initial deposit is, and they'll have to tell you exactly what the reserve ratio would be for you to be able to calculate that.
Okay.
Are there any other questions? So if there are no other questions, let's end here today. Remember, I'm avoiding going through too much chapters in detail because registration is only ending 31st of March, but on our timetable, we're already what? Scheduled with understanding that probably registration was ending what? 7th of March as well. So we need to start, but we need to now do a balancing act because we're expecting a lot other students to actually join us as well. So we're going to be starting, but we're not moving as fast as we usually do because we've started a bit earlier as well. Are there any questions? And please take note, you should be able to access the video of the next chapter. So on your user account, if you want to prepare for the next class, where we're going to be looking at chapter 2 and chapter 3 as well, you should be able to access the videos of chapter 2 and chapter 3 as well on your user account. If you don't have an active user account, please send me a WhatsApp, then I'll communicate with you at the end of the day after the classes. All right, enjoy the rest of your day.
Thank you, Reynolds.